Welcome to this session for CMA final students. This is your paper number 14 titled as Strategic Financial Management. My dear friends, these are revision videos where we will try to cover almost all the concepts of your syllabus for paper number 14 within a very limited period of time. In this videos, we will try to solve some minimum number of questions just to have the conceptual clarity. And the focus will be on revision of all concepts with conceptual clarity. So who should use these videos? Number one, a student who has already covered entire syllabus and wants to make an excellent revision in a limited period of time should use these videos. Number two, even if you are studying this subject for the first time, then to have a very sound foundation for this subject, you can use these videos. So, four major chapters we are going to cover over here. Number one is foreign exchange risk management. Number two is investment portfolio management. Number three is derivatives. And number four is capital budgeting, risk evaluation, and lease finance. So keep watching these videos till the end. And if you have any doubts, you can connect to me later also. I am your friend and mentor for the session. I am Tarun Mahajan. My qualifications are BCom, Diploma in Information Systems Audit, a Chartered Accountant, a Chartered Financial Analyst from CFAI USA, as well as a specialization in the finance, which is named as Registered Valuer. So if you have any doubts in future, you can WhatsApp to me at this particular number. With this, here I go with your first chapter. That is not the first chapter as per your study material, but the first chapter of this revision video titled as Foreign Exchange Risk Management. I have broken down foreign exchange risk management into four parts. First of all, we will discuss what is foreign exchange. Then we will discuss what is foreign exchange risk. Then we will discuss how to manage foreign exchange risk. That is foreign exchange risk management. And also we will explore many other connected concepts. So a first question is, what is foreign exchange? Foreign exchange is the mechanism, that means a machine. Foreign exchange is the mechanism by which one currency is converted into another currency. Suppose I have 1000 US dollars and I want to convert it into Indian rupees. So there exists a machine where if I input $1,000 as an output, I will get say 75,000 rupees, for example. It's not a physical machine like a photocopy machine where you insert a blank page and then you get out the photocopied page. No, it's not like that. It's a mechanism. It's a whole system which is operated by central banks like Reserve Bank of India, foreign exchange dealers, money changers, importers, exporters, borrowers, lenders. This whole group of people is a mechanism. So foreign exchange is the mechanism by which one currency can be converted into another currency. Okay, so I want to convert one currency into other currency. At what rate? I don't say what is price of the dollar. I say what is the exchange rate of the dollar. See, if I say what is the price of this remote control, then the word price is actually suitable over here. You know why? because I'm trying to get one commodity by paying currency, and that's why the word price is suitable. But if I'm trying to get one currency by paying another currency, then the more suitable word is exchange rate. What is exchange rate? Exchange rate is the rate at which one currency can be converted into another currency. For example, $1 is equal to 75 rupees. That is the exchange rate. Okay. Now, in practice, the home currency is written on the right hand side, but we will not strictly follow this rule in further discussion. Usually, home currency is written on the right hand side and the foreign currency is written on the left hand side in India, but that is not compulsory. The practice may change from place to place. Now, how do I express exchange rate? There are two ways to express an exchange rate. Number one is the direct code, and number two is the indirect code. What is direct code? When exchange rate is expressed in terms of number of units of home currency for 1 unit of foreign currency, it is the direct code. Keep in mind, if it is 1 unit of foreign currency, then this is the direct code. Now, we live in India, our home currency is Indian rupees. If an exchange rate is expressed like this, $1 is equal to rupees 75. This is 1 unit of foreign currency for number of units of home currency. Direct code. What is indirect code? If exchange rate is expressed in terms of number of units of foreign currency for 1 unit of home currency, then this is named as indirect code. For example, if I say to acquire rupee 1, I need to pay $0.0133. This is number of units of foreign currency for 1 unit of home currency, and it is named as the indirect code. There is a relationship between direct code and indirect code. If you want to calculate indirect code, it is 1 divided by the direct code. For example, the direct code was $1 equal to rupees 75. If I want to calculate indirect code, I'll do it like this: 1 divided by 75. So this is 1 divided by 75 equal to 0.0133, right? 0.0133. This is the indirect code. Let's take one more example. If I say that 1 pound is equal to rupees 90, you might say, sir, this is not the current exchange rate. My dear friends, all these rates are illustrative in nature, and I'm never saying that these are the current rates. 1 pound equal to rupees 90. In India, this code is a direct code. You know why? Because Indian rupees is our home currency, and this exchange rate is in terms of 1 unit of foreign currency for number of units of home currency. While on the other hand, if I say rupee 1 is equal to pound 0.01111, this is the indirect code, because this is 1 unit of home currency for number of units of foreign currency. You know, this code, pound 1 equal to rupees 90. Suppose you are a UK citizen, and if you are looking at this code, this will become indirect code, because for them, pound is the home currency, and this 1 pound equal to number of Indian rupees is in terms of 1 unit of home currency for number of units of foreign currency. So what is direct code for an Indian is indirect code for a UK person, and vice versa. What does it mean? This direct code and indirect code are relative terms, and if you change your country, then the direct will become indirect or indirect will become direct. In further discussion, we will not bother much about the direct and indirect code. Even if the direct code is given, we will use it. Even if the indirect code is given, we will use it. And we will never try to convert direct into indirect or indirect into direct. Okay, you have one question. Sir, where do I get these questions? See, these are on your screen. These are not, I'm saying that you must have these questions. Observe it on screen. If you want, you can pause this video, note down the question, or even can take a screenshot and later watch it. Identify whether the following codes offered by Standard Chartered Bank are direct code or indirect code. Right. The first one. This is $1 is equal to rupees 67. And this code is there in India. I have already written the answer for your convenience. This code is in India. So dollar is a foreign currency and this is 1 unit of foreign currency for number of units of home currency. That's why this is the direct code. Answer is already written over here. This code is in USA. $1 equal to rupees 67. This is in terms of 1 unit of home currency. Yes, this is 1 unit of home currency, and that's why the same code is now the indirect code. Okay, £1 equal to rupees 77 in UK. So this is 1 unit of home currency, and that's why this is the indirect code. Okay. Now, whether a direct code is given or an indirect code is given, the question is, how do I use the exchange rate? Should I multiply by the exchange rate or should I divide by the exchange rate? Suppose you have $1,000 in your hand and you want to convert it into Indian rupees. Now the question is, if the exchange rate is given, this $1,000 should be multiplied by exchange rate to arrive at number of Indian rupees, or these $1,000 should be divided by exchange rate to arrive at number of Indian rupees. All these depends on one simple rule of thumb. See, take an example. If dollars are to be converted into other currency, any other currency, maybe Indian rupees also. If dollars are to be converted into other currency and the exchange rate is given in terms of 1 unit of dollar for number of units of other currency, then simply multiply by this rate. Otherwise, you need to divide by the rate. What I'm saying is, I would like to repeat it. First of all, you decide that what currency do you want to convert. Sir, I have $1 million, $1 lakh, $1,000. I want to convert dollars. So number one, my starting point is dollar. Okay. If exchange rate is given for $1, multiply by the exchange rate. If exchange rate is given in terms of 1 unit of the other currency, then divide by the exchange rate. If you allow me to speak a little bit of Hindi, the same concept which I have just delivered, I'll repeat it in Hindi just to have a flavor of this concept. जिस करेंसी को कन्वर्ट करना है, like you have $1,000 and you want to convert it into some other currency. जिस करेंसी को कन्वर्ट करना है, that means dollar. अगर एक्सचेंज रेट उस ही करेंसी की 1 यूनिट में दिया है तो मल्टीप्लाई करेंगे, अदरवाइज डिवाइड करेंगे. If exchange rate is given in terms of 1 unit of the currency which is to be converted, then multiply by the exchange rate. But if the exchange rate is given in terms of 1 unit of some other currency, then divide by the exchange rate. My dear friends, keep in mind this rule, and any difficult situation, you will be able to use this rule of thumb and you'll be able to solve this question. Take an example. Exchange rate is $1 is equal to rupees 70. Now suppose you have $1,000 to be converted. So exchange rate is given in terms of 1 unit of the currency which is to be converted. That is dollars. And that's why you should multiply by this rate. $1,000 multiplied by 70 rupees per dollar is equal to 70,000 rupees. Right? But on the other hand, the same exchange rate is given, $1 equal to rupees 70. But at the same time, now the situation is you have 1 lakh rupees and you want to convert it into dollars. Now the given currency is 1 lakh rupees. The given currency is Indian rupees, 1 lakh. You want to convert it. If exchange rate is given for 1 rupee, multiply by the rate. If exchange rate is given in terms of 1 unit of other currency, that is dollar, divide by this rate. So if you want to convert Indian rupees into dollars and rate is given for $1, divide by the rate. So 1 lakh rupees divided by 70 will give you $1,428.57. Let's apply this concept to a question. The following spot rates are observed in the foreign currency market. In the first column, name of the currency is given. In the second column, rate of exchange is given in terms of $1 foreign currency per US dollar. So this is British pound and the rate is 0.62. It means $1 is equal to pound 0.62 is the exchange rate. $1 is equal to 1.90 Netherlands guilder. Dutch guilder is the exchange rate. $1 is equal to Italian lira. 1300 is the exchange rate. Now the European countries, they do not have their separate currencies. Rather than through the European Union, years back, they formed a group and they are following a single currency which is named as euro. So you don't have Dutch guilders or Italian lira nowadays because years back they have adopted a single currency named as euro. But for the sake of example, we can still use it. On the basis of information above, compute to the nearest second decimal number British pounds that can be acquired for $100. So now you can see that the given currency is US dollar. Exchange rate is also given in terms of $1. So we simply need to, come on, tell me. We simply need to multiply by this rate. So $100 will be converted into 62 pounds. Okay. Dollars that 50 Dutch guilders will buy. So now the currency is Dutch guilder. That is Netherlands guilder. 50 guilders. Okay, 50 guilders are there, but the rate is not available for 1 guilder. Rather than the rate is available for $1. It means I need to divide by this rate. 50 divided by 1.90 is equal to 26.32. $26.32. Okay. Italian lira that can be acquired for $10. You want to convert dollars into Italian lira. So you need a rate of $1. If rate of $1 is available, multiply by the rate. But if the rate for 1 lira is available, divide by the rate. So here the rate is available for $1 equal to 1300 liras. That's why you need to multiply by the rate. So $10 can be converted into 13,000 liras. Okay, we have solved this question here itself, so we don't need a separate solution now. Now you know how to use the exchange rate. So the next question, next obvious question should be, what are the various types of exchange rates? You see, all the foreign exchange transactions are carried out by authorized dealers. Anybody in India cannot start dealing in terms of foreign currency. Suppose you are a businessman, you are having a shop at the heart of the city, and you are selling some general stuff. And you put a board outside that besides the general store items, we also buy and sell dollars, pound, euros, and yen. No, you can't do that. To deal in foreign currency, you need to have a license from Reserve Bank of India. So all the foreign exchange transactions are being carried out by authorized dealers, which are usually commercial banks or money changers. Definitely, dealers carry out these transactions to earn a profit. Dealer will never do this thing that I buy dollar at rupees 70 and I sell dollar at rupees 70. If they buy at rupees 70 and sell at rupees 70, they won't be able to make money. And therefore, they offer the exchange rate to their customers after adding or deducting profit margin. So profit margin is always added. No. If you're selling something, you add the profit margin. If you're buying something, you deduct the profit margin. On the interbank rate, I will call it the wholesale rate informally. These adjusted rates are called merchant rates. Now, as per FIDI rule, FIDI, yeah, there is an association in India which is called Foreign Exchange Dealers Association of India. FIDI, Foreign Exchange Dealers Association of India. And if you're a foreign exchange dealer, you're bound by FIDI rules. So, when I talk about the arithmetic of exchange rate, what to multiply, what to divide, how many decimal points should be taken, all those things are not given in Foreign Exchange Management Act, but the whole arithmetic of the exchange rate is as per FIDI rules. So as per FIDI rules, merchant rates are quoted either up to 4 decimal points or up to 2 decimal points rounded off, while interbank rates are always quoted up to 4 decimal points. You must be thinking, what is interbank and what is merchant rate? To understand what is interbank and what is merchant rate, let's take one situation. So, for the purpose of a better understanding that what is interbank rate, what is merchant rate, first of all, you should try to understand one thing, that there are three types of people who are dealing in foreign exchange market. The topmost authority in the foreign exchange market is the market itself. Just for the sake of our understanding, we can say market means Reserve Bank of India. No. Practically, market is not Reserve Bank of India. It's a bunch of foreign exchange dealers who are dealing with each other. But for the sake of easy understanding, let's say the top authority is the market, that is the Reserve Bank of India. Then the other person who is dealing here is the foreign exchange dealer, or simply I'll say it a bank. And then at the bottom, the third person who is dealing in this market is the customer, that is the importer or the exporter, borrower or the lender, as the case may be. So you have the market, you have the dealer, and you have the customer. Customer cannot directly approach to the market because those who have the authorized dealer license can only approach the market. Customer, that is importer exporter, cannot directly reach to the market. There is a middleman which is named as the dealer, or simply saying the bank. So you have the market, dealer and customer. Market and foreign exchange dealer and the customer, that is importer exporter, for example. Now, as there are three type of people here, then two types of rates will be there. The rate at which transactions are entered into between the market and the forex dealer is named as interbank market. Because what is market? It's a bunch of banks, it's a bunch of dealers. So the rate at which transactions are entered into between the market and the dealer is named as interbank rate, while the rate at which transactions are entered into between a foreign exchange dealer and his customer, customer means the merchant, is called the merchant rate. So let's talk about interbank rate. Let's take an example. Now, interbank rate is not a single rate, it is a combination of two rates. So interbank rate should look like this. $1 is equal to rupees 68.1225 oblique 1375. 1375 doesn't mean 1375 rupees. Only decimal points are changed, hence only decimal points are returned. 1375 means 68.1375. This is how it is written. The smaller rate on the left hand side, and then the oblique sign, and the bigger rate on the right hand side. This is the way of writing the rate. The smaller rate, which is written on the left hand side of the oblique sign, is named as the bid rate. And this bigger rate, 1375, 68.1375, is written on the right hand side, of the oblique sign, and is named as the offer rate or the ask rate. So $1 is equal to rupees 68.1225 oblique 1375. This is how interbank rate is quoted. As per FIDI rules, interbank rates are quoted up to 4 decimal points, and usually last 2 decimal points remain in multiple of 25. So either it will be, last 2 digits will be either 25 or 50 or 75 or 00. The smaller rate, which is written on left hand side, is the bid rate, and the bigger rate, which is written on right hand side, is the ask rate. So why is it a two-way code? Think like that RBI itself is making the market, just for the sake of understanding. Or some very big bank like State Bank of India is the market maker. Friends, those who only sell something are called seller. Those who only buy something are called buyers. You go to a shopping mall, there are hundreds of shops. All of them are sellers. They don't buy. You go there and you ask, I want to buy this t-shirt, and they are ready to sell it. But you can't go with a t-shirt and ask them, would you buy it? They'll say, no, we don't buy it from the customers. We just sell it to the customers. Those who are only selling are the seller. Those who are only buying are the buyers. Those who are ready to buy as well as ready to sell the same stuff from the same shop, from the same set of people, are called market makers. So suppose State Bank of India, a very big bank in India, or Reserve Bank of India itself is the market maker. What does it mean? If they buy a dollar, if the market buy a dollar, it will buy at 68.1225, and after a minute, if somebody approaches them to sell these dollars again, they will sell at 1375. So difference between 1375 and 1225 is the kind of profit margin for the market maker. Market maker will buy at the lower rate from any dealer and will sell at the higher rate to any dealer. See, sometimes students get confused, and that's why I have uh, explained it. I'll explain it in two manners. The smaller rate is the bid rate, B for bid and B for buying. This bigger rate is asked, ASK is asked, and S for selling, right? B for bid, B for buying, and here you have S for selling. So this is the rate at which market is ready to buy, and this is the rate at which market is ready to sell. In any transaction, there are always two people. One is the quote maker and one is the quote taker. Quote maker and quote taker. You go to a shopping mall. You don't dictate them, okay, I want to buy this t-shirt for 2000 rupees. You don't dictate them the price. They disclose the price. They are the quote makers. And you are reading the price tag. Oh, this t-shirt, 2000, too expensive. So you are the quote taker. They have written the price and the price tag they have put on the t-shirt. They are the quote maker and you are reading it. You are the quote taker. So in this deal between the market and the Forex dealer, market is quote maker. Quote maker is the person who opens the rate, who tells rate to other people, and who is always ready to deal. So the market is ready to buy at 68.1225 and market is ready to sell at 68.1375. Difference amount becomes profit for the market maker. While in this deal, Forex dealer is the quote taker. It is not ready to deal, but it can deal. In a shopping mall, the shop owner is always ready to sell. But you as a customer can go, check it, try it, and if you want to buy it. Otherwise, don't buy it. It's your choice. You can deal, you can't deal. You may deal, you may not deal. Now, for a quote taker, the quote becomes reverse. If the market is ready to buy at 68.1225, Forex dealer can sell at this rate because market is ready to buy. That's why you can sell. And if market is ready to sell at 68.1375, that means you can buy. Market is ready to buy, so you can sell. Market is ready to sell, so you can buy. Look here, for the market maker, quote is always favorable. It buys cheap and it sells dear. It buys cheap. It can buy at the lower rate and it can sell at the higher rate. So market is ready to buy at the lower rate, ready to sell at the higher rate. For a quote maker, quote is always favorable. But for a quote taker, quote is always unfavorable. It can sell at the lower rate it can sell. And at the higher rate, it can buy. One who quotes the rate is called the quote maker. One who reads this quote is called the quote taker. For a quote maker, the rate is always favorable. It is buying at the lower rate and selling at the higher rate. While the quote taker, it can sell at the lower rate and it can buy at the higher rate. Okay, this is interbank rate, my dear friends. If we devote considerable amount of time on understanding the foreign exchange rate and how to use it, our foundation will be so strong then that when we will be solving difficult questions, you can easily crack those questions. Okay, now let's talk about the merchant rate. Merchant rate is the rate at which transaction is entered into between a foreign exchange dealer and its customers, maybe importer or exporter, for example. See, interbank rate is a market driven rate. There are buyers, there are sellers, there is continuous bargaining going on between buyers and sellers. This is how the interbank rate is created, right? So usually interbank rate is the result of the bargaining between the group of banks, that is foreign exchange dealers. This is a market driven rate. If there are more people who are ready to sell the dollars, this rate will come down due to higher supply. If there are more people who are ready to buy dollars, in that case there will be higher demand and this rate will go up. Interbank rate is the market driven rate driven by the forces of demand and supply, while merchant rate is simply a calculated rate. Merchant rate is calculated with the help of interbank rate. It does not have its own, independent buying selling forces. Merchant rate is calculated with the help of interbank rate. Now, suppose a foreign exchange dealer wants to earn a commission of 0.1% while making a deal with its customer. Then, how does he calculate the rate? I'll tell you. So, there is a formula. If you want to calculate the merchant bid rate, you take the interbank bid rate and deduct profit margin of 0.1%. Just try it on your calculator. On your calculator, type 68.1225 minus 0.1%. Use only those keystrokes which I am telling you. Turn on your calculator, type 68.1225 minus 0.1%. Round off the result up to 2 decimal points. That is the tradition. 68.05. This was 12 paisa. This is just 5 paisa. And to arrive at the merchant ask rate, you need to add margin to interbank ask rate. So turn on your calculator again. Type 68.1375 plus 0.1% plus 0.1% and round it off up to 2 decimal points. You must get 68.21. What is happening? That you are deducting margin from the bid rate and you are adding margin to the ask rate. I'll tell you rationale behind why deduct and why add. But now look here. The merchant rate, the difference between bid and ask rate is named as bid ask spread. Here the bid ask spread is a smaller number, 0.1375 minus 0.1225. But the bid ask spread of the merchant rate is 0.16, 16 paisa. Bid ask spread of a merchant rate will always be greater than the bid ask spread of the interbank rate. By its very nature, this is the bid which is lower than ask and you are further deducting margin. This is ask which is already a higher rate and you are further adding the margin. So from bid you deduct the margin, from ask you add the margin, the gap becomes wider. Bid ask spread of merchant rate is always greater than the corresponding interbank rate. Now between the foreign exchange dealer, that is suppose a bank, and its customer, Forex dealer is the quote maker. Try to recall that for a quote maker, rates are always favorable. So quote maker will buy dollar at the lower rate and it will sell dollar at the higher rate. Yes, obviously we are talking about dollar. Quote maker is ready to buy dollars at 68.05 and ready to sell dollars at 68.21. while customer is the quote taker. And you know, for a quote taker, the rates are unfavorable. So customer can sell dollars at the lower rate, that is 68.05, and can buy dollar at the rate of 68.21. You know, sometimes in an examination questions, it is not really very clear that whether you are a quote maker or a quote taker. In interbank rate, market is the quote maker, dealer is the quote taker. In a merchant rate, dealer is the quote maker and customer is the quote taker. But sometimes question does not specify whether you are the bank, that is forex dealer, or the market or the customer. Sometimes it's not really clear whether you are the quote maker or quote taker. Follow a simple rule. You are reading the quote, right? In the exam paper, you are not writing it. You have not written it. You are reading it, accepting it, taking it. That's why you are the quote taker. Believe me, this maker-taker concept will make your life simple. For a maker, rates are favorable. Buy at the low rate, sell at the high rate. For a taker, rates are unfavorable. Sell at the low rate and buy at the high rate. Okay, so let's come back to our point. What we have already studied is merchant bid rate is equal to interbank bid rate minus margin, and merchant ask rate is equal to interbank ask plus margin. You know, let's take an example here again for better understanding. Suppose I am an importer. I have imported a container load of material. I'm supposed to make payment of $1 million. I'll approach the forex dealer. I am the customer, that is importer. I have to make payment of $1 million. While my income is in terms of Indian rupees, I don't have dollars to pay. So I'll approach the forex dealer and I'll ask him, can you sell me $1 million so that I can make payment of my invoice? Now, foreign exchange dollar does not maintain stock of dollar, euro, pound, yen, etc. Foreign exchange dealer will simply approach the market and ask the market, will you sell me $1 million? So customer asks the dealer, will you sell me $1 million? Now dealer is asking the market, will you sell me $1 million? Market says, okay, we'll sell it expensive. We will sell dollars to you at 68.1375. So in turn, forex dealer will not reply to the customer that we will sell dollars to you at 68.1375. It will say we will sell dollars to you at 68.21. You know, so market will sell at 68.1375 and dealer will sell it at 68.21. That is by adding 0.1% margin, which is roughly 7 paisa. This is roughly 14 paisa. This is 21 paisa. So roughly 7 paisa per dollar will be the dealer's income. Take the reverse example. I am the exporter. I have exported goods. I have got $1 million. I go to the dealer and say, will you buy my $1 million? In turn, dealer will go to the market and ask, will you buy my $1 million? Market says, okay, bring in, we'll buy it at 68.1225, roughly 12 paisa. Now, dealer won't say the same thing to the customer that, okay, we'll buy your dollar at 12 paisa. It will say, okay, bring in your dollars, we'll buy it at 5 paisa. So now he'll buy at 5 paisa and market will buy from him at 12 paisa. And again, roughly, he'll make a commission of 7 paisa per dollar. This is how it works. Okay? Good. So merchant bid is interbank bid minus margin. Merchant ask is interbank ask plus margin. See, I already told you that interbank rate is freely determined by the forces of demand and supply. This is called two-way quote. The bid rate and the ask rate. Bid is lower, ask is higher. Market is ready to buy at bid and ready to sell at ask. While dealer can sell at bid and it can buy at ask. Merchant rate is a calculated rate. It's not a market driven rate. Again, it is also a two-way quote. The lower one is bid rate and the higher one is the ask rate. Bid is the rate at which dealer is ready to buy and ask is the rate at which dealer is ready to sell foreign currency to the customer. Okay, good. Now, FDI rules are not really very important for us, so I can simply skip it and I can come to a question. What to buy, what to sell, at what rate to buy, at what rate to sell. We'll discuss all these points now. So we have one question for better understanding, and intentionally I have taken a quote in which Indian rupee is not one of the currencies. See, whenever I see Indian rupee, I become comfortable. Oh, yeah. But intentionally, I have taken a rate of euro versus US dollar. So this is actually number of euros per US dollar. Usually practically anything can happen, but most of the time if a rate is written like this, euro oblique US dollar, euro divided by US dollar, it means this is the rate for 1 US dollar. The currency in denominator is having 1 unit. In general, though the opposite practice is also there, but unless otherwise stated, I can say this is the rate for $1. So I'll say $1 is equal to euro 0.9345 and 0.9375. First of all, this question does not specify whether I am the market or the forex dealer or the customer, whether I am the code maker or the code taker. So I have already given you a tip that if the question is silent, assume yourself to be the code taker. Assume yourself to be the code taker. What does this mean, that assume yourself to be the code taker? It means that rates will remain unfavorable for you. So you can sell dollar at the lower rate of 0.9345, while you can buy dollar at the higher rate of 0.9375. Question is silent. Assume yourself to be the quote taker. That is, rates are unfavorable. You can sell at the lower rate. You can buy at the higher rate. So sell what or buy what? Yen or euro or dollar or Indian rupees or pound or what? Australian dollar or Canadian dollar? What can I buy? What can I sell? See, the exchange rate is given for $1. It means we are talking about buying and selling dollar. I'll give you one simple, very important tip over here. Always think about the currency for which exchange rate of 1 unit is available. So don't think about buying or selling euro in this question. It will always be easy to think about buying or selling dollar. Why should I think about buying or selling dollar? Because exchange rate is given for $1. And if you think about buying or selling dollar, it will be easy for you to interpret and use this exchange rate quotation. Okay. So let's think about buying and selling dollar. Even if the question says buy euro, you'll say, okay, I am buying euro. It means I am selling dollar. So just think in terms of dollars, not in terms of euros. Question says sell euro. You'll say, okay, I'm selling euro. Oh, it means I'm buying dollar. This is one very important rule you keep in mind and your life will become simple. I already told you, you need to understand that I am a quote taker. I'll sell dollars at 0.9345 and I'll buy dollars at 0.9375. Okay, now this one is not important for me. Now look here. What is the cost of buying euro 1,25,000? See, I'm buying euro. It means I'm selling dollar. So you just need to think about sell the dollar. You can sell dollar at 0.9345. So first of all, out of the two rates available in the question, you are able to identify the rate which is relevant for you. And that rate is actually 0.9345. Now the next thing is you have euros in your hand. If rate is given for 1 euro, you'll multiply by the rate. But if rate is given for $1, you should divide by the rate. And here the rate is given for $1. So you should divide by the rate. And if you divide by 0.9345, result will be $1,33,761. So if you want to buy 1,25,000 euros, you'll have to pay $1,33,761. See, look at the B point. How much would you receive by selling euro? 49,300. I have decided that I'll think in terms of dollars only because the rate is given for $1. So selling euro means buying dollar. Okay, if I'm buying dollar, being the quote taker, I'll be able to buy it at the higher rate, unfavorable rate of 0.9375. So number one, you have identified the rate. Number two, should I divide by the rate or should I multiply by the rate? See, you have euros. If rate is for 1 euro, multiply. But the rate is for $1. So better you divide by the rate. By selling 49,300 euros, you will get $52,587. Now, number 3, C point. What is the cost of buying US dollar 78,500? The question itself is saying you're buying US dollars. Buying US dollar, you'll be able to buy it at the higher price. So if I'm buying US dollar and selling euro, you need to think in terms of dollar. It is already in terms of dollar. So you are actually buying dollar and you will be able to buy it at the higher rate of 0.9375. The question is, should I multiply or divide? Rate is already given for, dollars are given and rate is already given for $1. So you need to multiply by the rate. 78,500 multiplied by 0.9375 will give you roughly 75,000 euros. And now look at this. What is your receipt if you sell US dollar? Sell dollars, okay, I'll sell dollar. But I'll be able to sell dollars at the lower rate of 0.9345. Now multiply or divide. See, $63,400 are there. And the rate is also for $1. So I need to multiply by the rate. 59,247.3 euros. I request you to pause this video over here and replay it, this entire question 2 times, 3 times, so that you have crystal clear grip on this concept. Okay? What to buy, what to sell, at what rate to buy, at what rate to sell. Should I divide by the rate or should I multiply by the rate? We have answered all these questions. Okay. Now moving to the next. Calculation of merchant rate, which is a very easy task. Calculate merchant rate given the following interbank rates and their margins. £1 equal to Indian rupees 66.3250 oblique 4525. So 3250 is the bid rate, 4525 is the ask rate. Most probably, these are interbank rates. Not most probably. In fact, question itself is saying these are interbank rates and you are required to calculate the merchant rate. Now TT selling rate. TT stands for telegraphic transfer. For the selling rate, you want to earn a margin of 0.13%. For the buying rate, you want to earn a margin of 0.03%. So what does it mean? It simply means that this is interbank rate, and to calculate the bid rate, I'll take interbank bid 66.3250 and deduct the margin. Yes, for the bid rate, the margin is deducted. While buying, you'll buy at the lower rate, 0.03%. And if you solve it, you'll get it equal to 66 point something something, rounded off to 2 digits, and it will be 66.31. Now for calculating merchant rate, you need to add the margin 66.4525 plus 0.13% is 66.54. Now I told you about the bid ask spread. If you calculate the bid ask spread over here, it will be 66.4525 minus 66.3250. So the spread in the interbank rate is 0.1275. Now, if I calculate the spread for merchant rate also, it is 66.54 minus 66.31. So that is 23 paisa. Here it is roughly 13 paisa. Here it is 23 paisa. Why the bid ask spread of the merchant rate is higher? Because bid has become even lower due to deducting margin, and ask has gone further higher due to adding margin, and that's why this gap is there, right? Okay, let's explore buying selling rate once again. I want to buy pounds. The question is, at which rate can I buy? If nothing is specified, I am the quote maker. So what do you want to buy? First of all, you decide you want to buy pound or you want to buy rupees. If question says buy pound, fantastic, rate is given for £1. So think about buying pound. But if question says buy Indian rupees, then you will say, okay, I won't think about Indian rupees because the rate is given for £1. Question says buy Indian rupees, it means sell pound. Think it like that. And then, are you a customer or dealer or the market and nothing is specified, you are the quote taker. Accordingly, you can decide rate. So suppose I am the quote taker, it means that I can sell pound at 66.3250 while I can buy pounds at 66.4525, being the quote maker. Okay. So suppose I want to buy 1 lakh pounds. I want to buy 1 lakh pounds. Suppose I am the quote taker, because nothing is specified, I'll be able to buy it at 66.4525. Now I want to buy 1 lakh pound. So this should be multiplied by 1 lakh. It will become 66 lakh 45,250 Indian rupees to buy 1 lakh pounds. Okay, so this was just an introduction to what is foreign exchange. We'll continue it in the next session. Thank you.